Okay. So welcome everybody to today's lending panel interview. We have with us two very experienced lending or loan officers, Josh Anderson and Shauna Tucker. Both are from Idaho. This class was kind of born out of a session that I believe Shauna did for the Idaho group in Boise, and it was like, wow, that's really good information. We should share this amongst the larger group, and so that's part of why we're here today. And then Josh is here to talk to us a little bit about some of the different kind of cool loan programs that are out there. Thank you for attending today. We really appreciate your time and effort. Hopefully you can get some nuggets out of here to help your clients achieve their goals in real estate. So again, my name is Eric Johnson. I am the Director of Training for Northwest Real Estate Brokers, which comprises of the Sotheby's, Century 21, and Coldwell Banker franchises for Western Montana, Idaho, and Eastern Washington. So we will start our day off with Mr. Josh Anderson. Josh, if you want to introduce yourself and then take us into your presentation, we'll go from there.
Sounds good. Thanks, Eric. Yep. Hey guys, my name is Josh Anderson. Like Eric said, born and raised in Idaho. Been here with Idaho Central Credit Union now for just over 17 and a half years. So quite a long time and some experience in here. So yeah, like Eric mentioned, I'm going to talk more about I guess how do buyers and sellers maybe take advantage of this market, if you want to call it that, with the way the rates are going and kind of how things are shifting, and some products and tools and services out there that maybe think outside the box a little bit and see if we can help some more buyers out get in here. So a couple things that we talked about with the rates going up is obviously maybe some affordability, right? So, you know, when rates were at 3%, you can afford this much of a house. Now they're at 7%, you're still looking, how much can you afford? And how can we maybe help combat that affordability? And we talk about affordability, we're mainly talking about, I mean, I guess technically your debt to income ratio, how much do you make, how much your payment is, and then how can we shrink or grow one of those to help out with the price of your home to buy. And I wrote down a couple things here I'll kind of touch on, and we'll go into it a little bit more. But you know, one of the things we're seeing a lot right now is adding a cosigner, you know, to add some more income there, maybe add a cosigner on to help you out. Maybe we pay off a little debt, maybe you put a little bit less money down and use some of that money to pay off a car loan that has a $400 payment that only has a $4,000 balance to free up some more income, so some more monthly obligation there. Maybe we do a rate buy down, maybe we do a PMI buy down, maybe we switch your loan programs that have different rates and PMIs and factors like that to help out. Maybe we do the recast loan, maybe we'll do loan assumptions, you know, things like that. So all kinds of stuff there to look into. So I'll share my screen here if that's okay. And there should be some slides. Can you guys see those? Okay. So the first slide I got up here is kind of our welcome home, our home loans, what loans are out there, not so much just the credit union, but just kind of in general of, you know, what can buyers do, what can they look at, what options they have to get some financing and help them out in this type of market. First-time home buyer programs, conventional loans, FHA, RD. Really popular one right now is ARM loans. We'll go into a little bit more of that here shortly. They're becoming very popular because the rate is quite less than a conventional loan with the market rent. Jumbos, condos, manufactured homes, you know, Idaho, Washington loan programs, all of the above. So slow me down if I start talking too fast. I can get a little excited and kind of nerd out on this stuff. So bear with me here. So let's talk about adjustable rate mortgages. One of the most popular options right now that we're seeing out there is an adjustable rate mortgage, ARM loan, meaning the rate can change, right? So it's not fit for everybody. There's a risk tolerance there. Some people love them, some people don't. But it's an option out there that I think needs to be brought up, I guess, if you will. All kinds of different terms on ARM loans specific to us. There's a 5, 7, and 10-year term. That 5, 7, and 10-year means that rate is fixed for 5, 7, and or 10 years, whatever you choose. And then there's an adjustment period. Ours are 5, 6, 7, 6, and 10, 6. That means after the 5 years are fixed, that thing can change every 6 months after that. So there's where you see the risk comes into play. You know, if you're going to be in the home less than 5 years, if you're going to do what we've been saying, you know, marry the home, date the rate, maybe you're going to keep the loan for 3 years, and then you're going to refi it to get a better rate when they go down, if and when that happens. So there's options out there and reasons to take an ARM, and then there's also reasons not to. You know, like I said, there's some risk tolerance there. If it's going to be a forever loan, then you probably don't want to do one. If you're definitely going to refinance a couple of years and under that term, probably a good option. One of the things we have going now that really increases some buying power is we have a first-time home buyer ARM that allows for 100% financing and no PMI. And so when you're talking, comparing that to like an Idaho housing option, they have 100% finance options, but they have PMI, then you tack on the down payment assistance. You're talking $400 or $500 a month savings there between a first-time buyer ARM opposed to like a Idaho housing down payment assistance option. But again, it's an ARM loan. There's some risk there, but that's $400 or $500 a month of initial upfront savings to help you get into a home now, and then possibly refinance in the future when that comes up. Go for it.
Couple of quick questions. One is that are all of your ARMs right now back to a 6-month adjustment period once the year, or because a lot of times you hear the 10-1, 7-1, 5-1, which is a 1-year period.
Yep.
Okay, so everything.
All 6 months. Yeah, we just switched.
Okay.
We had a 5-5 ARM. We just changed to basically mere Fannie Mae guidelines now on our ARM programs.
Okay, and then the second question I have is if I let's say I bought a house with this adjustable rate mortgage, and it's much less, and then a year from now or whatever the rates go down, is there any prepayment penalties for refinancing back out of that prior to the ending of the term, the initial term?
No, zero. No prepayment penalties, no nothing. You know, you are going to pay some refinance costs that can be built on loans, sometimes with discounts on title insurance there for the reissue fees, depending on your time. No prepayment penalties for any of the loans.
Okay, cool. Awesome. Thank you.
So good questions there. But yeah, so you're going to start seeing and probably hearing, if you haven't already, this ARM loan thing. Dig into the terms. Make sure you're reading your audience and your buyers if it's their thing or not. Again, not something it's fit for everyone, but right now it's a great option where the rates are. If we think the rates are going to be temporarily stuck this high, a great option there.
And then one more thing, Josh, before you continue, I just want to I forgot to let the group know who's attending. If you have questions, put them in the chat, or I'm sorry, the Q&A down below, so we can make sure we get all your questions answered. And once each presenter gets done with their slides, we'll try and go through and make sure we get all those questions answered.
Perfect. So that's kind of ARM loans. If anybody has questions, please let me know. Again, they kind of vary from lender to lender and case by case, but the bottom line is it's adjustable rate loan, and the initial rate is usually way less. So you're going to take advantage of that, add some buying power there, and then possibly, like I said, if things align themselves, you can refinance in a couple of years or whenever that may happen to go down. So a great option there to get some more buying power. Another option we have, extended rate locks. You know, if you have, this is a great option for new construction, depending on what you think the rates are going to do. You know, 6 months ago, we're at 4%. Now we're at, went to 7. Now we're back down to 6.3. But if you were to lock in 4% 6 months ago, your buying power probably different than it is today. If you didn't lock in, sometimes you maybe don't even qualify anymore because of that rate that changes so much. So be on the lookout for extended lock options. And again, it's what you think is the trend of the rates going up. Typically, when you do an extended the rate lock, you're not locking in the lowest posted rate at the time because of the risk of the extension rate locks. You're taking a little bit of bump up front. But if you take a 0.25% bump up front from 4 to 4 1/4, and by the time your house is done, or 7%, you hit a home run on that rate lock. There's options out there to go all the way up to 360 days, depending on what time your build is going to be done. Free float downs, refundable fees up front. Great option if the rates continue to trend up to get in now. Again, now we're at a point where we're already at 6.5, and who knows where we're going to go from here. But 6 months ago, we did a lot of extended rate locks, and a lot of those guys are pretty happy with where they're at. Even at the time, it kind of seemed, why am I doing this? I'm taking a 0.25% hit right now, but they're still way down. So a great option there. And again, adds buying power if you can get in that lower rate and get locked in this home, opposed to waiting, and then again could bump you out from buying, or could bump you out from qualifying there, depending on what the rates are. You just have to get less of a house, or do some different tools, right? So extended rate lock's a great option. We do offer, or there is other options out there too. called a lock and shop. I'm sure you've probably heard of it or familiar with it. Basically what happens is you can get pre-approved for a home, and then you can choose to lock that rate in without an address or a contract. For us, it's up to 90 days where you shop for a home. So you can lock in now, and then when you shop for a home within 90 days, you can keep that same rate as you locked in now. So again, buying power, if the rate jumps up 2% in 90 days, you could be hundreds of thousands different on a home or a mortgage or whatever the case may be. So a lock and shop is a great option for that as well. Something we'll share with everybody and give them the option to do so on that.
So on the extended rate lock, you talk about a float down that we might have some newer brokers or agents with us today. So that just means that at some point, so if I lock in, let's say I lock in at 6 today, and then within a month or something, I have a purchase agreement or anything, and then the rate drops to 5.5%, or I'm not closed on a transaction. I suppose I can float it down prior to closing. Is that correct?
Yeah, 30 days prior to closing one time. So that at least with
30 days prior to closing. Okay.
Yeah. So if you lock in at 6% today and the rates go to 5% prior to closing, you can float down to what the current rate is at the time.
Okay.
So your risk is kind of mitigated, I guess, if you will, a little bit. You're locking in that you're for sure not going to go any higher, especially for an extended period of time. But if they don't move up as fast and high as we think they are, then you can get back down to where they were.
Yeah.
One time, 30 days prior to closing is our program. Everybody's got a little bit different set, but it's probably similar.
Okay.
Any other questions on that extended rate lock or the lock?
There was one question that since it's just one, I'll just do it right now while we're on the slide. On the lock and shop, for the 90-day, is there a float down attached to that or no?
Yes, you can. So on a lock and shop, the 90-day, you can buy your float down, $500 to buy it down.
Okay.
So depending on if that makes sense or not, depending on how far they went down, we could weigh those options for you and run the scenarios and things like that. If $500 is going to get you down a quarter, which is well worth it. If $500 is going to get you an eighth and you're going to keep it for 6 months, is it worth it? Well, we can run those scenarios and see.
So the extended lock, I have a contract attached to that, and the lock and shop, I don't have a contract attached.
Got it. Yep, you got it.
Got it.
Great questions. A couple of things we'll touch on here really quick is I'm going to hit on rate buy downs and maybe using some of what we're seeing now as probably you can attest to is maybe some more seller credit, some more lenders or some more builder credit, things like that going out there, and some large stuff, people offering to buy your rate down quite a bit, often 20, 30, 40 grand, whatever it is to buy your rate down to get that affordability in. That is an option. We offer it. Pretty much every lender will offer the rate buy downs. The amounts and the distance to buy it down can vary. And then we can help you work on kind of best use of funds there, if you will. Buying your rate down 0.25% is, going to change your payment $40, opposed to maybe using that money to maybe prepay PMI and save $200 of PMI monthly payment instead of $40 a month on your rate payment. So a lot of people talk about the rate buy downs. They're getting a lot of traction, and they are very popular because we're getting a lot more seller credits and we can use that with the rate buy down. But sometimes, depending on how much the money is and how much the rate buy down costs, we'll try to maximize your affordability by weighing that with the PMI option, if you have PMI, or the rate buy down option, what kind of nets you more to boost your affordability up a little bit. Does that make sense?
Yes, kind of. Right.
I ran some scenarios here because, like I said, rate down is a huge talk right now. And I get the question, how much does it cost to buy a rate down? And then what does that do to your payment?
Right. So
I ran some scenarios here, and back when we were at 6.5, it's about $38 a month on a $500,000 loan amount to buy the rate down for every eighth of a percent. For every eighth of a percent in rate, you're saving $40 a month.
Got it.
And that's going to cost you anywhere between, it varies. That's the hard part. It varies
because it floats every day, right?
Correct.
So really what you help people analyze is what the recapture is. if you're going to save $40 a month, but it costs you $800, well, okay, that's, 20 months.
Right.
Probably not a bad deal. If it's going to cost you, $5,000, it probably doesn't make sense to buy that rate down for that less of a payment. Now, it also depends on who's paying for it. If it's the seller offering a buy down, and they're going to okay, and then that's built into the price, maybe that's maybe not quite as big of a deal to a buyer. But if the buyer's paying for it, that recapture is kind of a, again, what you guys help and you do analysis on, so they understand what they're getting
It's
into.
kind of your break-even point, if you will. How long does it take you break even? How long do you plan to keep a loan? What's going to be your best fit for you here? But very popular, a lot of hype right now, a lot of talk. We can offer them, everybody can offer them. It's just a matter of, is that the best use of the seller funds for your affordability? And like I said, we can kind of help gauge that. So any questions on the rate buy downs? Nothing. So the other things that I kind of touched on here, cosigner. So cosigner is a great option. Maybe you qualified when you were pre-approved 3 months ago and the rates were 5%, and you were trying to qualify for home, and you want to keep in that same price range, but your income and debts have not changed. Well, we can look to add a cosigner, which will help your income and offset that monthly payment, so you can qualify for a little bit more of a home to keep that buying power up. One other thing that's pretty popular as well that we also look at is debts. Some people, everybody asks us, how much more do I have to put down to get my payment here, or how much more do I have to put down to qualify for this amount, which is great, and we can do that. But sometimes you'll look at a borrower's debts, and maybe they have a $4,000 car loan out there that their payment on it is $500 a month. Instead of giving me $10,000 to save $60 a month, they pay off that car loan for $4,000 and save $400 a month, and then boom, the buying power goes through the roof. And so there's an option there that we try to think outside the box a little bit. Not so much down payment, if you have more than the minimum, if you will. Let's move some other options to extend your buying power by paying off some small debts, if that's an option. So another powerful tool there that we try to reach out to buyers that right away, first thing to talk about that. We talked about rate balance, we talked about PMI. We also offer a recast on loans, and most lenders do, meaning if you want to make an offer, and I know this is kind of gray area here, whether a contingent offer is accepted right now or not, if you will. If you have a buyer that owns a home and has a bunch of equity in it, but they can't sell it or don't want to sell it until they move into their new home, you have an option to make a non-contingent offer as long as they qualify for both loans. And sometimes maybe they don't even have a loan on the home they're keeping, but they have a bunch of equity in, obviously. So when they sell it, they can then apply that money toward the new loan. We call that a recast. And then what we do is you keep the same rate and term, but we'll reduce your payments and drop any PMI all for free. And so you can come to us after the fact and deposit that money with us to pay your loan back down, and get it back where you would have done if you would have sold beforehand. That's very common for non-contingent offers. You can't get an offer accepted, or you can't sell your home. Let's look at some other options. How can we help you get into the home now and fix you up and apply it down the road?
So recast is going to be very similar to like a bridge loan, is that?
Yeah, people, it does get, I guess, what you consider maybe confused with the bridge loan. I mean, we call it a recast. You do have to qualify for a new loan, and you do have to put 5% down, just like you're buying a new home. And you can borrow your 401k, whatever you need to do, get from family, whatever, because you're going to get money eventually from the sale of your house, one or the other. And you can kind of pay all that back at the time, but it does kind of sub as a bridge loan. And a lot of times, maybe it does pay off the entire loan inside your house, which is great. A lot of times it just pays it way down, where you would have had $300,000 down instead of 5% down. And then you can apply that. You keep a little loan at the end, but allows you to get into the home non-contingent without selling your home.
Sure.
And then a couple of loan programs out there that have not been used so much in the past that are going to become a little bit more popular. like I said, is the first-time home buyer stuff, the ARMs, doctor loan. So we offer a doctor loan, and most people do as well. The kicker for the doctor loan is we're talking affordability and down payment. We don't count where there's no PMI. You can put as little as 3% down, and you don't get hit for your student loan payments. So big buying power boost with no student loan payment debt, no PMI, and you only have to put 3% down to qualify. So you're talking big buying power boost there when you're not counting those type of things into the factor. And then lastly, like I said, first time home buyer stuff, the jumbo stuff, the conventional, the condo. Like I said, with the rates the way they are and helping people get into those homes, we will, like I said, help you come up with options to increase your buying power with all the other solutions we have to talk about.
That's great, Josh. Well, thank you so much. Is that, I'm not cutting you off too early?
Nope, you're good. That's about all I have.
So cool. So, and Josh, you're operating out of Boise. We just had Aaron Marsh with ICCU present at our Spokane and Coeur d'Alene offices. And I know for the Century 21 Butler people on here and Sotheby's people in Coeur d'Alene, you might have your own reps dedicated to your offices. But just so you know, ICCU is in all of our markets. So if you have questions about that, feel free to reach out.
Yep, we're just kind of moving into Spokane, opening branches and moving in up there like crazy right now.
Yep. So thank you, Josh, for the information. That was awesome. Let me look through the questions real quick. It says, can you explain the 2-1 buy down? Is that a temporary buy down?
Great question. So the 2-1 buy down, I'll preface it by this: we don't offer it. It's very popular. It's gained a lot of traction lately. But basically, and Shauna, maybe you can chime in here too, as well as if you know a little bit. But basically, you're getting 2% off the rate the first year, 1% off the second year, and it goes back to posted rate the third year. So huge savings in the first year or two. So yes, it is temporary, and it's coming from the seller, the way I understand, and it's just helping you pay down the payment for the first year and the first 2 years. So if you do something with in that time frame with your house or your loan, I believe you do lose it, but it's a huge savings for 2% the first year, 1% the second year. Very popular right now.
Interesting. Okay, thank you. And then recast just means you have to qualify for the two loans. So if you have an existing loan.
Yep.
Okay, so that was easy. And then Joan asks, with regards to the doctor loan, do nurse practitioners, PAs qualify as, or do they need to be doctors?
Let me clarify really quick. I got it right here because it's a big list. So it must be nurses and PAs will not qualify. It's a resident practicing physician, oral surgeon, optometrist, etc. So not nurses or
Dentist.
Dentist, yes.
Okay.
Oral surgeon, dentist, DDS.
So I just remember that hangover part when he's like, "You're not really a doctor. You're a dentist." I did that. I have a dentist in my Rotary Club. I had that joke one time when I was up at the front of the room, and he did not find it funny at all. Didn't have the same. He didn't laugh as hard as I did when I saw it on the hangover. So don't ever do that. So cool. All right. Well, Shauna Tucker, I will introduce you. The Benchmark Mortgage. Also out of Boise. So I will let you take it away and talk to us about loan assumptions and how we might be able to help direct our clients to resources to help them decide if this is a good option for our buyers or sellers.
Wonderful. Thank you, Eric. Happy to be with you all. I'll tell you, I'll share my screen because I've got some information that I think will be valuable as well. Are you seeing the one that says about me? That one? Are you seeing my screen, everybody? Perfect. Okay. A little bit about me. I have been a loan originator since 2002, a branch manager at Benchmark Mortgage since 2010. My husband, my team and I are VA loan specialists. So this class on assumptions was born from a request from the VA community about how VA loan assumptions work. And was expanded then later to kind of encompass all of the major loan programs that you all would probably run into when you're thinking about loan assumptions. We are licensed in the entire Pacific Northwest. So my team and I do a tremendous amount of VA business in Idaho, Oregon, and Washington. So veterans comprise about 5% of the overall population, but it's about 60% of our business. So we have seen and experienced just about everything you can run into when you're working with military clientele. And the rest of our business is probably just a mix of the remaining 40% conventional FHA, USDA, and some of the loan programs that are just standard in the industry. I'm also a real estate and mortgage instructor. I teach for the National Association of Realtors, the Idaho Association of Realtors, and a lot of local associations. And that's my connection with Michelle. She and I have collaborated on some classes before. So that's just a little bit about me. But let's look at loan assumptions in particular.
Hey, Shauna, apparently we're having, our group of boys is having trouble hearing you, and I don't know. I'm hearing you fine, but I'm not sure exactly how to maybe fix that.
This is better if I get a little closer to my microphone.
There you go. Is that
better?
Better, Michelle?
Is that okay?
Okay, cool.
So what we'll touch on today is what loan assumptions are and what they're not, and some of the pros and cons associated with assuming versus getting a brand new loan. We're going to look at the history of assumptions. So what a simple assumption is versus a formal loan assumption. We'll briefly touch on what types of mortgages are assumable and when they wouldn't be assumable. An important factor in the process is what is the process? What are the timelines? What are the fees associated? So we'll touch on that, as well as the buyer requirements for assuming a loan. And then I'll do a special carve out on considerations if you're working with a seller who has a VA loan. So some special considerations that your veterans are going to want to consider. And we'll wrap up with some tips to protect your buyers and sellers during the loan assumption process. And some, I think I have a few affordable mortgage options that I'll tack on that will maybe explain, like that 2-1 buy down, for instance, and whatnot. Okay, so an assumable mortgage is a contract that allows the seller of the home to pass responsibility for their existing mortgage onto a new buyer of a property. So in other words, a new homeowner who is assuming the mortgage, and along with it, they're going to assume ownership of the property that secures the loan. So what it isn't is it's not a new loan and it's not a refinance. So what does that mean? If your seller has had their mortgage for, let's say, 7 years, and they have paid it down to $300,000. What your buyer is assuming is that loan. So they're assuming the remaining term. It's not a new 30-year note. They're assuming it with maybe a 23-year payoff or payment projected payment schedule left. And they're assuming it at the current loan balance. So oftentimes there's an equity gap there that your buyers are going to have to figure out a way to make up. Sometimes they're going to be utilizing a second mortgage. Sometimes it'll be cash, but that's one of the obstacles with an assumption is how do you make up that gap between the mortgage and what the home price is? So one of the things to think about. In the old days, we used to see, and by old days, I think 70s and 80s, probably nothing that most of us have seen during our careers for the last at least 20 or 30 years, I would say. But in the old days, mortgages were allowed to be assumed through a simple assumption process. In today's world, most lenders only allow for a formal assumption. What's a simple assumption? And something for you to watch out for and think about when you're protecting your clients. So a simple assumption is where the lender's not involved at all. The buyer's going to take over the seller's payments. The seller is still liable on the loan. So nothing has been arranged with the lender. The lender may not even know that a new party is actually making the payments on the loan. The risk associated with that is your seller is still liable. So if your new buyer doesn't make the payments and the property ends up in foreclosure for some reason, that's impacting the seller's credit, and also that from a foreclosure perspective, and also that payment history, the seller is technically still liable. Okay, again, this has not been allowed on mortgages in a very long time. So if you have somebody who's advertising that they can do a simple assumption, I would caution you to really look closely at the paperwork they signed when they closed their transaction. Alternatively, what we are seeing a little bit of and upticking in today's world are formal assumptions. These are much more protective for your seller because your lender, whoever the seller is currently making their payments to, is going to be very much involved in that approval process. So your potential buyer is going to be looked at just like they would if they were getting a brand new mortgage. So your lender's going to be approving them, looking at credit, income, assets, all that good stuff. The buyer is going to replace the seller on the loan. As such, the seller is no longer going to be liable and their credit won't be impacted. So if the buyer were to default, if the home were to end up in foreclosure, your seller isn't going to run the risk if they've gone through the formal assumption process. And formal assumptions are allowed on some of the common mortgages you'll see in today's world, but not everything. So what types of loans are assumable and what are not assumable? So the first one that really does comprise a large majority of the loans that you'll run into that your sellers have are just conventional plain Jane fixed rate loans. So those loans have a due on sale clause on them and are not typically assumable unless you have something that it hasn't been sold on the secondary market. So sometimes a conventional loan will be a private portfolio loan. Not necessarily everything is being sold to Fannie Mae or Freddie Mac on the secondary market, but most of the conventional loans that you see are sold on the secondary market, are going to have a due and sell clause and won't be assumable. The exception on conventional is the adjustable rate mortgage. So conventional adjustable rate ARMs are typically assumable. Again, it depends if we're talking about a Fannie Mae, Freddie Mac loan or a private portfolio loan, but most of the adjustables you run into might be assumable. Probably not seeing too much of that with the history of low rates that we've seen. I doubt there's very many adjustable rates out there to assume, but if you have a client who has one, then potentially worth looking at their paperwork to determine if their loan's assumable. But also the government loans, FHA, VA, and USDA loans are all assumable as well. So how do you determine? You're going to ask your client to pull out their closing paperwork, and the easiest, probably quickest place to find out whether or not the loan is assumable is either their closing disclosure, if the loan's closed in the last 10, 12 years or so, or if it's an older loan, they're going to be looking for their truth in lending disclosure. And right on there, it'll indicate whether or not their loan is assumable. All right, typical fees and timelines. This is an important thing to understand up front. Fees are going to vary a little bit from lender to lender. If you're doing a VA loan, they're gonna cap the lender fee at $300, but every other type of loan doesn't have those same restrictions. So before a buyer would want to assume, you would want to reach out to the lender, whoever your seller's making the payment to find out exactly what their fees are for the assumption. They're also going to charge you for a credit report and a title search. You'll have a closing escrow fee and or a notary fee. And then I'm not sure if depending on the area, you might have transfer taxes and always typically recording fees. So it's almost like a modification to the note where the new buyer is going to substitute for the seller. And so there will be a little bit of additional paperwork that is recorded with your county. And on VA only, they're going to charge a small funding fee of 0.5%. And it's not going to be wrapped into the loan. So for your veterans or for a veteran, assuming, I guess any buyer really assuming a VA loan, there's going to be about 0.5% fee tacked on to that list of closing costs. Timelines associated with an assumption, they're going to vary dramatically from lender to lender. And I would say this is one of those things that's absolutely critical to find out early in the process. And as assumptions get more and more popular, I would expect those timelines would be more and more extended, right? And so it's not going to probably be the same as working with one of your favorite local lenders where they're trying really hard to, keep their closing timeframes within 2, 3, 4 weeks. You might have extended closings. So just know about that, be cognizant of it, reach out and understand it before you put together your contract, and you should be safe. All right. For the buyers, lender approval is going to be required on all formal assumptions. What does that mean? We're going to be, or the servicer, I shouldn't say we, because what Josh and I both do is the front side, working with purchase transactions rather than assumptions. But the lender, the servicing side of the lending department, is going to still be looking at your client. They're going to still be looking at their credit history, their credit score, their debts and obligations, their income and employment, debt to income ratios. And if they have cash to close, they're going to be analyzing that as well. That's important because it might be easy to assume that if your client is getting a second mortgage, or if the buyer on a transaction is getting a second mortgage, it's really important that that information is disclosed to the lender upfront, because there's going to be a new payment associated with it, and it's got to be factored into the qualification. So you can imagine you wouldn't want to find that out at the last minute. You would want something like that to be disclosed to the lender upfront so that there were no hiccups or bumps along the way. Additional requirements at closing: your buyer is going to agree to assume responsibility on the mortgage, and your seller is going to be released from liability. If you don't have that, you're not working with a formal assumption, you're working with a simple assumption. All right, special considerations on VA transactions. First thing, the lender is going to require all of the same criteria or have all the same underwriting guidelines that they would on any other type of loan program. So your servicer is still going to be looking at income, employment, debts, assets, all of the same stuff. But on top of that, the VA has a requirement that says the loans cannot be delinquent. So if your veteran seller has gotten behind on their payments, then they're going to have to bring those current before the assumption would be able to be completed. Additionally, your veteran seller should always consult with a VA loan expert before allowing an assumption. And there's a couple reasons why. It impacts greatly what their VA loan benefit and their future VA loan benefit. So the VA loan can be assumed by veteran buyers. It can also be assumed by non-veteran buyers. If it's assumed by a veteran, then the selling veteran and the buying veteran can apply to the VA to have their entitlement replaced. So the buyer's entitlement or benefit could replace the seller's entitlement or benefit, which would then mean that the seller's benefit is fully restored and available for use again on a future VA transaction. What doesn't happen is any of that automatically. So it's just something that your veteran seller needs to be aware of. It's not going to, the VA is not going to automatically do it. They're going to have to take extra steps to go to the VA to have their entitlement restored. If the VA loan is assumed by a non-veteran buyer, a couple things are going to happen. The VA is going to ask that the buyer indemnify them. So the way the VA works is they guarantee 25% of the loan amount. With a veteran buyer, they don't necessarily go after the veteran if they ever had to pay on a defaulted loan. But if you have a non-veteran purchasing the home, then and they were to then subsequently default on the loan, then they would have to indemnify the VA and be willing to pay back anything that the VA paid on a claim or a loan guarantee, if that makes sense. And it also impacts the future benefits of the veteran. So the way VA entitlement works is it's kind of like a checking account. And when a veteran utilizes their VA loan benefit, a piece of that benefit is used to secure the home loan. depending on how much of a purchase price the veteran is utilizing, they may use up all of their entitlement, or they may only use part of their entitlement. And so if they allow a non-veteran to assume the loan, then some of their entitlement is tied up in that property, which may mean that they might still have some VA benefit they can use, or they may not. And I think it's really important that your veteran at least just understand the impact if they're accepting an assumption and how it works. I'm going to go over really high level, very quickly how it works. But again, it's not a lender who's going to make the judgment call on how much of their benefit is impacted. It really is the VA that makes the final judgment call. So you can kind of guess where and how much it'll impact their benefit. But again, at the end of the day, it's going to be the VA who always provides the benefit and the amount of the benefit. Okay, so the first thing to take into consideration, if your veteran seller is allowing their loan to be assumed, is that if they only have one VA loan at a time, then the VA has no loan limit. So there, in theory, could be a $3 million zero down jumbo VA loan if a lender will allow it. Some lenders have overlays and they won't do the VA jumbos, but in theory, the VA loan program allows for zero down jumbo loans up to no loan limit, really. If they have partial entitlement, and this is a relatively new change to the program, just so you know, it was a result of the 2019 Blue Water Navy Act. And so it's only been since 2020 that we've had zero down VA jumbos. Before that, VA loan amounts were capped at the same as the Fannie Mae County limit for loan amounts. So if you haven't heard about that, it is a relatively new change to the program. If your veteran has more than one VA loan, and that could be multiple sources, that could mean that they've kept a property and they're utilizing it as a rental. It could mean that they've had an old foreclosure and part of their VA entitlement was tied up with that. And it could just mean that they allowed one of their VA loans to be assumed. Then they have something called partial entitlement. And here's how partial entitlement works, just high level in a nutshell. The VA is going to take a look at the current county limit. So this year in most areas, the county limit is $647,200, but we're close enough to next year that I just threw in kind of what we're expecting to see for loan limits in the coming year, which is about, we're expecting they'll come in around 715, maybe 700, 715, somewhere in there. So they're going to take the county loan limit. They're going to subtract out the amount of the loan that was guaranteed, the original VA loan amount that was guaranteed. And the remainder tells our veteran how much they can buy utilizing zero down with their VA benefit if they have partial benefits. So in this particular scenario, if the loan limit was 715, the original loan amount was 250, then the remaining entitlement ends up being about 465,000. That's the amount your veteran can then utilize for zero down VA loan program. So let's take that scenario and then we'll translate it out to a new purchase. So hypothetically, let's just say that same veteran with $465,000 in entitlement wants to purchase a $500,000 house. From 500, we deduct what their remaining VA entitlement is, and the difference in this scenario is $35,000. Now, the VA guarantees 25% of the loan amount to the lender. And so the VA only requires that the veteran come up with 25% of that difference. So they don't have to come up with the full 35,000. What they have to do is come up with 25% of that 35,000, which is the equivalent of about 8,700, 8,750. Okay, so still a very small down payment on this scenario, less than 2% down. So that in this situation where you have a relatively small loan that's being assumed, it works out pretty well for the veteran, and their remaining entitlement might be sufficient for them to use the benefit again. But if you have a really large loan that's being assumed, those numbers might not crunch out the same way. They might not be as positive for the veterans. So again, just one of the potential pros and cons that a veteran should take into consideration before they allow their home to be assumed, or their loan to be assumed, sorry. And then just a few quick tips, things for you to think about when protecting your clients. The first one I would say is understand the assumption process, understand the process, the timeline, and the fees. And I would do that before you negotiate. Because again, every lender, it's not going to be like working with your local lender that you have a relationship with, and they're going to be striving really hard to meet that contract closing date for you. It's going to be a servicing department that you may or may not ever talk to again. And you just don't know what their timeframes are going to be. Okay, so and then possibly think about something in your contract that if it was due to a delay in the assumption process that protects your buyers or your sellers. Okay, the seller should still request pre-approval letters from my perspective. They should reach out to their lender after the buyer has made application and see if they can get a pre-approval letter that says we've looked at income, assets, and credit, etc. They may or may not get it, but it's worth asking for. If they're getting a second mortgage, if the buyer's getting a second mortgage to make up some of that gap for some of the down payment, I would ask for a pre-approval letter on that as well. And I would highly encourage your buyers to still get a regular pre-approval from a mortgage lender as a backup. Because remember, if you send your client to a trusted lender and they say to you, oh, there's no way we're going to be able to approve this, high likelihood that they're also not going to get pre-approved through the assumption process, because the assumption process is still looking at all the same things that a lender would be looking for upfront in the pre-approval typically. Third, that we kind of already covered, is that your veteran sellers should always consult with a VA loan expert to understand how it impacts their VA loan benefits and whether or not, even compare, you know, if I accept an assumption, this is what my VA loan benefit looks like versus comparing it to a conventional loan for a future purchase or something like that. And then last but not least, I would say that buyers should still shop for a mortgage. And there's a couple of reasons why I would recommend that. First of all, if they are getting a gap loan, a second mortgage for the difference between the loan they're assuming and the purchase price, those second mortgages typically come with higher interest rates. And so it's worth knowing whether or not a new first mortgage, even though it have a slightly higher interest rate, would pencil out better than a second mortgage with a large interest rate and an assumable first mortgage that has a lower interest rate. So those should definitely be compared. And then typically a second mortgage isn't going to fund 100% of the purchase price. So a second mortgage might not be the full solution. They're probably still going to need somewhere about 20% down to come up to be able to purchase, even with an assumption, if they're utilizing a second mortgage for the gap funds. Rates aren't the only thing that impact the cost. So when you're assuming a loan, if you think back to the type of mortgages that are assumable, and they were conventional ARMs, they were FHA, USDA, and VA loans. Of those, both FHA and USDA have monthly mortgage insurance tacked onto them, and possibly the conventional adjustable rate mortgage would as well. So at least 3 of those options have some sort of monthly mortgage insurance potentially, and that can offset the lower interest rate. So if you have a buyer who's putting 20% down, does it make sense to assume a loan, even with a lower interest rate, that has mortgage insurance on it? Maybe, maybe not. So again, it's worth really taking a look at what that loan payment's going to be combined with the second mortgage payment, and then comparing it to a new purchase loan transaction as well. And then, you know, once you're under contract, you have pretty much fallen in love with a house in most cases. And so I would say, to protect buyers and sellers, they should definitely reach out and have an approval from a mortgage lender for purchase, just in case something goes south with the assumption. Why don't we pause there, Eric, and see if there's any questions?
Got a couple. I have Dean Tucker wants to ask a question. Dean, I can allow you to talk if that's easier. I don't think I see your question in the Q&A. So Dean will let you go first, and then I'll go down through the other list of questions. How about that? You there, Dean?
I think he's on mute.
Oh, he is muted. You're still muted, Dean, if you're trying to talk. All right. Dean, are you able to join us or? Okay, I'm gonna go to the other questions. Please bring that up. So Chris Goff asked, obviously someone typically wants to assume because of the lower rate, how is the lender compensated? And would it be more lucrative to write a new loan? And who has oversight on that process?
Yeah, excellent question. So when they're assuming a loan, so when you get, let's start with when you get a brand new purchase loan, typically you're gonna see that a lender has an origination fee, sometimes other lender fees, maybe you'll see processing or underwriting fees, that kind of thing. And that is the large percentage of how a lender is compensated when you do a brand new loan. There's also something called service release, where when we sell the loan on the secondary market, we get some payment from the servicer, because the servicer knows they're going to make a profit over the long period of time where they're collecting payments, right? And so some of that servicing is purchased from the originating lender. So for the most part, that's where a lender makes their money. When you're just assuming a loan, it's not going to be so much of a profit center for the lender. They're looking more to cover their fees, if anything else. And there's a strong benefit to loan servicers to keep loans on their books, because when loans pay off fairly quickly, then what they've paid to get that loan through the service release is they're not going to break even. So their interest is to keep the loan on the books and to keep the mortgage interest profits coming in on that loan.
Yeah, that's interesting. I didn't realize they were incented to do that, but that makes sense. Now that she explained it, thank you. Shelley Whelan asks, do you think you could recast an assumed VA loan if buyer has more cash and wants to buy down the loan balance?
Yeah, excellent question. And the VA loan is one of the few loan programs that cannot be recast, and that is not specific to a particular lender. It's just the VA loan program in general.
Federal
So, no, unfortunately.
Okay. And then Kelsey asks, what if the veteran has a power of attorney? Can that loan still be assumed?
So the veteran seller has a power of attorney to sign on behalf of the veteran.
Kelsey, do you want to clarify that? Yes.
Yeah. So this is a technical question that I would say is probably going to vary from servicer to servicer. I don't know the answer 100%, but what I can tell you from my experience on the front side originating loans is that, as you all probably have experienced as well, is that those power of attorneys typically have to be specific power of attorneys and not general powers of attorney. So I would guess that that's similar, but just know that's a guess.
Okay, awesome. Those are the questions we had so far.
Good. Okay. And I think we're probably out of time, aren't we?
Yeah, we got 5 more minutes or 6 more minutes.
Okay, let me just throw some things out there. Most of these are things that Josh touched on, so I'm not going to go into them in depth at all. But there's a couple things, like in lieu of assuming a mortgage, there's other things that the industry, the market is just looking at to make it more affordable for buyers and give the sellers a little bit of an edge. And I think the first thing to know is that, and I'm going to skip this one, is that there's a limit on how much, if you are looking at seller concessions, there's a limit. All loan programs have a limit in terms of how much the seller can pay towards a buyer's closing costs. So as you're thinking about your negotiations, you don't want to over negotiate how much the seller is willing to pay, because the loan program might not allow that much. So, and I'm happy to share this chart if anybody's interested. Discount points is something that Josh touched on, and they vary every day. A discount point is a permanent rate buy down, the amount it costs to buy from one rate to the next rate down is going to vary a little bit from day to day, just like interest rates vary a little bit from day to day. But the thing that I want to point out is if you were like, here's a chart where you show like the absolute maximum discount points on the particular day that I pulled them were 2.4%. And if you look at the savings from, taking your full price interest rate down to a deeply discounted interest rate, you're seeing a monthly payment savings for your potential buyer of almost $200 a month on a $480,000 loan. And that is just 5/8 of a point on the rate. If you took that same $11,000 that it takes to buy down that point, which $11,000 is a lot, don't get me wrong. But the same amount, if you're reducing your purchase price by that same amount, your buyer's only saving $64 a month. So this is where I would say it does make sense to get with a lender ahead of time and look at some of these options of, using instead of using a seller concession to buy down the interest rate versus using or asking for a concession in terms of purchase price. Somebody asked about the 2-1 buy down, so I want to touch on that. The way a 2-1 buy down works is it is a temporary rate reduction as compared to discount points, which are a permanent rate reduction. And money is set aside in a custodial account. Think of it like an escrow account where there's money, just much like you would have money set aside to pay your taxes or your insurance. Really, in essence, the way a 2-1 buy down works is your payment is fixed for 30 years at the end interest rate. Let's call it in this scenario 6 7/8. You're temporarily setting aside enough money to have a payment of 4.875 for the first year, 5.875 in the second year, and then at the end of the second year, it ends up being 6.875, or the money is exhausted from that savings account. So for the first year, that money is about $600 a month that is getting set aside in that savings account. The second year, it's about $300 a month on this scenario. So the total cost again is close to $11,000 on a $480,000 purchase price. So again, it's a huge difference for the buyer. You're maybe looking at about $59 a month with a price reduction versus $600 a month for the first year and $300 a month for the second year. That money is in a savings account in essence. So if the loan were to pay off early, then that money just is applied towards the principal payoff. So the money isn't lost, but it's also not refundable in terms of cash. It just applies towards the payoff. The same scenario is available in a 3-2-1 buy down, but the price gets really expensive because that first year to buy down the interest rate 3 points, while it's possible, doubles the expense on the 2-1 buy down. So, but again, if you use that same money to buy down or lower the purchase price, then the impact, the bang for the buck on the monthly payment just isn't quite as much, if you will. What else do we have here? Josh touched on this one, monthly MI versus prepaying the mortgage insurance. Mortgage insurance can be very expensive. So sometimes it makes a lot of sense to, apply that money towards buying out the mortgage insurance instead of buying down the interest rate. So again, a lot of bang for your buck on that one. But the thing to know about monthly mortgage insurance is that it really is very much tied to credit score. So that one's not going to be a one-size-fits-all scenario. Strong credit is going to be way more affordable than people with just kind of a middle of the line credit score. But again, both are worth looking at to figure out where you're going to get the most savings for the client. We have here, Josh talked about the fixed versus adjustable rates. And those are super strong, outstanding products as well. I'm not going to go into those in great detail, but you can often get, 1/4 of a point, 1/8 of a point, 1/2 of a point lower interest rate if you're willing to take a period of time up front that's fixed, whether it be 3, 5, 7, or 10 years. Okay. And then streamline refinances are something that is something we're factoring in, especially with our VA clients right now, because what we see is that house prices are probably looking like they're going to hang steady, maybe maybe appreciate a little bit. But refinances, we go through a refi boom every 3 to 7 years in the mortgage industry. So there will be some opportunity. And if your clients have one of the government loans, such as an FHA, USDA, or VA loan, there's a nice, quick and easy streamline refinance that can be utilized when and if the mortgage rates, if mortgage rates drop. By simple, I mean, there's no credit check on it, except for a mortgage payment history. We're going to be making sure that they paid their mortgage as agreed. There's no income they're verifying, and there's no appraisal. So it's just really a quick and easy rollover into a new lower interest loan. Most conventional loans won't allow it, but most of the government loans will allow it. And that's it, guys.
Awesome. Thank you so much for all of that information, you guys, Josh and Shauna. I really appreciate it. There's a wealth of expertise here. I think I see one more question. Can you get her to pull up the limits on seller paid costs for the different loan types again? Maybe we could show that. Maybe take a screenshot of that. Yeah, I mean, I learned a bunch of stuff that I didn't know today. So I've been doing this 27 years. So that was really, really cool. I really appreciate you guys taking the time. And thank you to all of you who attended. Hopefully you got a nugget or two out of this to better help your clients in this shifting market. And yeah, I think we're